welcome back to the fourth revolution. I'll talk about stocks for your portfolio of the future. Today is the sell-off edition of the fourth revolution. We've got all of the major averages in the correction territory after this interest rate driven sell-off that has dragged the market buoys, mega cap tech down into, like I said, correction territory, which is a 10% or more drop from recent highs. And it's kind of a self-fulfilling prophecy. This new market that we're living in today is not only hyper fast, driven by individual investors, but it's driven by technicals as well as a broader market consensus, which has not been the case in the past. And we saw it yesterday with a record number of engagement in the markets. There's the highest volume day since the sell-off back in March of 2020, the pandemic sell-off, and it's because there's more people in the markets than ever before with more cash than ever before. And they're buying the dip. So the S&P 500 dipped into correction territory for the first time since September of 2020. Like I said, 10% plus correction, and it bounced out of it quickly. So it was down as much as 4% yesterday, but moved up and was actually in the black by the end of the day as buy the dip investors jumped in with seemingly little hesitation around noon. And it was a huge noon reversal we saw. Today we're headed a little bit lower, but I thought it'd be a good opportunity to take a look at the charts, take a look at the opportunities here going into this Fed meeting. And a lot of this pullback is predicated on the idea that the Fed is going to be a little bit more aggressive with its rate hike timeline, and people are a little bit concerned with mega cap tech reporting this week. The bulk of earnings season, really, we're at the heart of it right now, and investors are just de-risking their portfolios, and at the same time, we're seeing people buy the dip. So there is a deviation, and it's very clear that there's a penchant for high growth as these stocks have fallen over 50% below. Many of them have fallen over 50% below their latest high. And there's opportunity in this market left and right. It's just a matter of timing, and it's a matter of what the Fed's going to do moving forward here into this January meeting, which will conclude on Wednesday with Jerome Powell announcing to the markets what not only his policy is, but what his sentiment is about inflation, which hit a 40-year high in December as far as pace of inflation goes. And now we're looking at an environment that we've never seen before. Jerome Powell is saying that we're in a different world, and I believe him more than ever with the speed of these equity markets just being unreal. Like I said, we moved down 4% to noon yesterday in the S&P 500, and then moved right back up another 5% off of that. And it's just because of the number of new investors that are flooding this market with enthusiasm. So let's take a look at the charts and take a look at the technical levels. So that'd be a good idea to do a level check as the S&P 500 dips into correction territory with investors de-risking their portfolios ahead of this Fed meeting, which is highly uncertain as Lil Brainerd, the new vice chair, takes her seat next to Jerome Powell, and she has a more hawkish tone, as we've seen with her congressional confirmation hearing earlier in the month. So now we have big tech as well, and investors are a little bit worried with already seeing inflation crunches, or should I say margin crunches caused by inflation in earlier earnings. They're worried that big tech is going to reflect the same thing, and they are pulling profits prior to their earnings. This is going to be the S&P 500 chart, and we have, like I said, come down over 10% from these highs at the beginning of the year, all the way down to we actually hit 420.22. 42.22. And that was the low of yesterday. There wasn't really a level except for excessively oversold from an RSI standpoint, which you can see down here. And we got buyers in the afternoon, just like clockwork at that 10% level. There was a lot of demand for people's favorite stocks. And that was the level that we were all looking for. It was a 10% pullback from recent highs. And it was mega cap tech that did it. And this is the NASDAQ 100, which represents the mega cap tech holdings with the top 7, tech firms in the world, making up about 50% of this market leading index. And this thing has corrected nearly 20%. It almost fell into bear territory as investors get concerned about interest rates, and the first thing they're going to target when they're concerned about interest rates are these high growth names. And with mega cap tech's buoyancy until this year, they kind of were the market buoy throughout the last 2 years of trading. And now that we're ending 2022, they are pulling profits off of these names, and it is causing this correction that we're seeing today. And creating some opportunities, as well as a enormous amount of volatility. You can see that actually we held up at a support level here on Monday and are continuing higher from there. But we're still bouncing around. There's still a ton of chop in this market. You can see this with the S&P 500. It is still holding the levels that we wanted to hold today, right at 42.90, it looks like. And it's because of the elevated number of institutional investors and individual investors as well that are using these tools like Fibonacci extension levels to price out in time their entry into the market. And that's what we saw this morning with the jump off of this key 161.8% Fibonacci extension level. And it could have been a temporary bottom for us. So let's take a look at Fed funds expectations. And this is really the key of what's driving the market action as of late. You can see that from now compared to last month, the expectations of a 4%, or should I say 4 rate hike, which is going to be 1%. Each rate hike represents 25 basis points, has risen significantly. So 4+ rate hikes for 2022 is now priced in at 60%, maybe a little bit more than that. And even the 5 rate hike outlook is looking larger than ever. But like I said, Jerome Powell has been extremely accommodative to the markets, and I don't believe that is going to be the case. I think it's more likely that we're going to see 3 rate hikes and an accelerated asset roll-off, which is going to be a little bit more market accommodating as far as how shocking it is. I think that's what people are worried about going into this meeting. Is they're worried about a monetary shock, which would pull down the markets. But like I said, Jerome Powell has been way too accommodative, even in the face of 40-year high inflation. I think that he is going to ease us into this monetary tightening. And you can see it with the 10-year here. We've traded effectively sideways for nearly a year now as far as the yield goes. And we did touch 1.9 last week, but we're coming down as, kind of the demand for this quote unquote risk-free asset spikes in the face of this market sell-off. So be careful in this choppy market, guys. I know the S&P 500 has corrected that 10% that we were all looking for. And this is actually a perfect time to start adding to your favorite positions. I wouldn't put it all in, as a bottom is pretty difficult to call with volatility like we've seen in the last few trading days. Honestly, the last 2 years of trading, we've seen crazy volatility, and the speed of this market is just unbelievable. So you want to make sure that you do price average down, scale into these positions so you can get the most favorable pricing in these long-term investments. I personally am looking at stocks for the future that are focused on this next generation of economic growth, which I expect to be a little bit more accelerated than what we've seen in the past as digital technology takes hold of our global society. So don't forget to check out Zacks.com/promo, where you can take a look at finding #1 stocks by our VP Kevin Matris. And again, check that out at Zacks.com/promo. Thanks for watching, guys. Look forward to speaking to you guys next time.